Start with the puzzle. This morning, Tuesday, August 18, 2026, the euro remains subdued near 1.1630 against the US dollar, even after Germany's ZEW economic sentiment survey showed investor confidence has continued to stabilize. Normally, a stronger ZEW reading gives the single currency a lift, because the survey captures what financial professionals expect for the next 6 months. Today it failed to do that. That is the real story. The euro is not trading on German confidence alone. It is being held back by a deeper mix of sticky inflation, energy risk, and concerns about global trade policy. Look at what has changed under the surface. First, German inflation rose by 2.8% in July, stronger than many analysts expected, and that limits how aggressively the European Central Bank can cut rates. Second, some Frankfurt strategists now warn Eurozone inflation could average close to 4% across the year, roughly double the ECB's 2% target. Third, energy risk is back on the table. Earlier this month, renewed tensions around the Strait of Hormuz pushed Brent crude up 5.4%. And fourth, German economic institutes still flag uncertainty over US trade and tariff policy. That cocktail explains why improving sentiment has not translated into euro strength. Here is the market reality. One valuation model estimates the euro is trading 2.5 to 3% above fair value, which means it needs consistently good news to justify its level. Today's ZEW stabilization is simply not good enough. The failure to rally on improving German sentiment is a classic bearish signal. When a currency cannot rise on good news, traders start wondering how it will behave on bad news. For UK viewers, the effect is more visible. A soft euro keeps European imports and continental holidays cheaper, but it also reveals that the Eurozone recovery is fragile. That matters for British exporters, because weak Eurozone demand tends to spill over into UK trade. What happens next? The next catalyst is the minutes from the US Federal Reserve's July meeting, due this week. If those minutes sound hawkish, the dollar could strengthen and push the euro towards lower support. On the European side, if August inflation stays close to 2.8%, the European Central Bank may be forced to sound more cautious about future rate cuts, which could actually cushion the euro. But if Brent crude spikes again or US tariff uncertainty worsens, the single currency could break below its recent range. The base case is not a crash. It is a slow grind, sideways to slightly lower. The bigger takeaway is this: the euro is not collapsing, but it is trapped. German sentiment has stabilized, yet inflation near 3%, persistent energy risk, global trade uncertainty, and an overvalued exchange rate all weigh on it. That leaves traders with no strong reason to buy the euro today. Watch whether the currency holds its current range, because a break below support would signal that Europe's slow-motion recovery is losing momentum. For now, subdued is not calm. It is the market's way of saying it still needs real evidence before trusting the euro.